What if the company you thought you had fully mapped, every metric, every catalyst, every risk factor, suddenly began moving in ways so abnormal and so strategically uncharacteristic that it felt less like a business and more like a puzzle? What if the stock's behavior began contradicting the fundamentals, the disclosures began contradicting the company's history, and the capital structure began contradicting everything you thought you understood about how firms of this size behave? That kind of rupture does not happen often, but in 2025, Bitfarms forced investors into that exact psychological space. Bitfarms, founded in 2017 and long regarded as a conventional Bitcoin miner operating across Canada, the United States, Paraguay, and Argentina, had spent years playing a well-understood role. It mined Bitcoin, it scaled rigs when conditions were strong, it tightened operations when mining margins compressed. The business was volatile, yes, but predictable in its volatility. A traditional miner's life cycle revolves around ASIC upgrades, energy cost optimization, and hash rate growth. That is the standard operating logic of the sector. Beginning in 2024, Bitfarms started violating those expectations. Not with small deviations, but with seismic, pattern-breaking decisions that suggested an internal transformation so aggressive that it almost seemed implausible. The 2024 financials were the first hint. Roughly $193 million in revenue, up more than 30% year over year, and losses narrowing to around $54 million, nearly a 50% improvement. A miner in that position would normally double down on mining, deploy capital into newer generation ASICs, and expand site output ahead of upcoming Bitcoin halving cycles. That is the industry norm. Bitfarms did the opposite. Instead of reinvesting in mining infrastructure, it began exploring a complete structural repurposing of its assets. In early 2025, it enlisted Appleby Strategy Group and Worldwide Technology, firms usually hired by hyperscale data center developers, not miners, to evaluate converting portions of its 1.2 gigawatt North American energy footprint into high-density AI and HPC campuses. Miners do not behave like this. They expand or contract fleets. They do not redesign their power infrastructure around an entirely new industry. When a firm breaks sharply from sector patterns, it often means its internal strategy has already evolved far beyond what the public realizes. Soon after, Bitfarms exited its Argentina mining operations. Under ordinary mining economics, foreign sites are sold during liquidity distress or when energy costs blow past break-even thresholds. Yet Bitfarms' liquidity was rising, not falling. Selling into strength is not how miners usually behave. This suggested an asset curation process, a clearing of distractions to prepare for something much larger. That larger ambition became clearer when Bitfarms acquired about 180 acres in the Panther Creek region of Pennsylvania in mid-2025. It immediately announced plans for a 350 megawatt AI and HPC campus. Nothing about that scale fits miner behavior. It fits hyperscale colocation providers and infrastructure REITs. Around the same time, Bitfarms revealed an even stranger decision. Its 18 megawatt Washington facility would be fully converted, not upgraded or partially retrofitted, but rebuilt from scratch into a high-density AI campus engineered for NVIDIA's GB300 class GPUs, with liquid cooling and rack densities near 200 kilowatts. Conventional Bitcoin mining racks usually sit around 5 to 10 kilowatts. A jump to 200 is not evolution, it is reinvention. Then came the financial shock. On October 10, 2025, Bitfarms converted its Macquarie lending facility into a $300 million project finance structure dedicated to Panther Creek and immediately drew an additional $50 million. Standard miners do not use project finance. They take equipment loans, do sale leasebacks, or rely on short-term credit lines. Project finance belongs to utility-scale developers. 6 days later, the company issued $300 million in convertible senior notes, then upsized the deal to roughly $500 million due to demand. The coupon was around 1% with maturity in 2031 and capped call structures to reduce dilution risk. Two major financings totaling nearly $850 million within 2 weeks is not normal for any mid-cap company, especially not a miner. When firms compress financings at this scale, it usually means they are preparing for something immediate, capital-intensive, and transformative. This underlying tension surfaced fully on November 13th, 2025. After the market closed, Bitfarms reported third quarter revenue around $69 million versus the roughly $85 million analysts expected. Net loss was near $46 million, more than doubling the previous year's loss. Under normal circumstances, a miss like this from a miner would lead to a sharp sell-off. Instead, the stock held steady and then climbed. The reason was hidden in the same disclosures. Bitfarms unveiled the complete Washington conversion plan, a fully funded, liquid-cooled, modular, high-density AI campus with about $130 million in secured supply chain commitments. That meant execution was already underway. The market started valuing Bitfarms less as a miner and more as a future AI infrastructure landlord. By late November 2025, the stock traded near $3.5 below the 5-day, 10-day, 20-day, 50-day, and 200-day moving averages. RSI stayed around the low 40s. Support formed at $3.20, $3.05, and deeper around $2.90. Yet earlier that year, a golden cross appeared, black, showing long-term strength. Short-term signals were weak, long-term signals remained constructive. The chart mirrored the company's identity crisis, and that identity is the heart of the mystery. Bitfarms is no longer behaving like a miner. It is acquiring land, raising capital, and building like an AI infrastructure developer. The market must decide whether this new identity is real, executable, and durable, or whether it is a dangerous overextension carried by hype rather than fundamentals. For traders, the playbook becomes clearer. In the short term, the $3.20 support level is critical. Losing it opens downside into the upper $2 range. In the medium term, accumulation between $3.50 and $4.30 becomes a belief-based strategy built on confidence that 2026 construction milestones will materialize. In the long term, Bitfarms becomes a binary asset. If the Washington site energizes in 2026 and Panther Creek phases in across 2026 and 2027, Bitfarms could justifiably trade near $6 or $7. If execution fails, the path back toward $1 becomes possible. As you listen, know this. ValueStir is actively watching, and we are waiting for your suggestions. If you have stocks or crypto assets, public, private, or soon to list, that you want investigated in this same deep dive style, drop them in the comments. Tell us what mysteries you want uncovered. Your engagement drives what we cover next, so your comments matter more than you think. And to everyone who subscribes, shares, comments, and sends these videos to friends and communities, thank you. Your support makes it possible to keep bringing better investigations, more rigorous analysis, and content designed to help you navigate markets that are changing faster than ever. This was ValueStir.